if I can get it to advance. There we go. Um, Errors in internal controls. Basically, what if you make unintentional mistakes on financial statements? Disagreements. We're going to discover that there's actually a lot of estimates and judgments that have to be made in accounting. And we'll talk about those. Sometimes we have incentives that could lead to the potential of errors and fraud also. And then when it comes to fraud, intentional errors and management manipulation of financial statements in order to make our numbers look better than they really are and deceive investors. So all things we have to be thinking about. Accounting errors. You probably have discovered after working the first 4 chapters that making an error in accounting is actually a fairly easy thing to do. And so errors in transactions or journal entries, you book something for the wrong amount, you book something in the wrong accounts, errors in accounts and ledgers. It's very easy to post to the wrong account, and it's very easy to post for the wrong amount. So all kinds of errors can be made unintentionally that would result in financial statements being off a little bit and being not 100% correct. So of course, because of the types of mistakes that can be made, we need to have some safeguards in place or controls in order to prevent those to the best that we can. So internal controls is just processes that we put in place internally in order to protect assets, right? Make sure that the assets of the company are being used properly or safeguarded, and then also to increase the reliability of our accounting records, meaning that we've got a pretty good, reasonable way in place to assume that amounts are posted for the correct amounts, that our journal entries are correct, they've been reviewed. Just basically, how is our work once it's done? How was it reviewed for accuracy to prevent those mistakes from happening? And so it's basically just comes down to internal controls. And the nice thing about internal controls is that most of you listening to this probably have been involved in internal controls, even if you didn't realize that or not. But almost any job that you would have, there's going to be training. There's going to be a certain way to do things, typically a right way and a wrong way. And a lot of that comes down to controls and being able to capture data, measure input, measure output, whatever it is, just to make sure that your job as you do it is done accurately. Okay, and so the control environment, what they mean by that is what is the actions of management, what are the policies in place, what are the procedures that happen, and just what is generally management's attitude about controls, right? So you want a control environment where there is continued training, where new people who were hired are put through a rigorous training program, where there's continuing education, management's very involved in ensuring the accuracy of information. There are consequences if information is not done correctly, things like that. Okay, that's really what they mean by that. Accounting systems, of course, just think a general ledger. We've kind of learned more of a manual basis of doing a general ledger and having journal entries, posting to accounts, adding those up, creating a trial balance, those things. Obviously, at most businesses, those things are actually very automated, and we're learning it from a manual perspective so we understand the mechanics of how this all works. But just know that when we have accounting systems, obviously there needs to be a number of controls in place to make sure that data that is extracted from an accounting system is accurate and can be relied on. And then what they mean by control procedures are just simply those things that are in place that monitor the activities that we do and make sure that those activities are being done in a right way. So when it comes down to controls, you've got preventative and detective controls. Some good preventative controls. The first one there is segregation of duties, basically making sure that no one person has too much responsibility, especially when it comes to involving company assets or booking to accounts, things like that. Okay, and so what they mean by preventative controls, segregation of duties, is if we have one person in our office who is responsible for reconciling our bank accounts and doing the bank recons, that person should not have any cash handling duties. Okay, because if you've got cash handling duties and you're doing the bank recon, you're in a position where you could fraudulently steal from the company. Okay, and so it's just little things like that, making sure that no one person has too much responsibility. Proper procedures for authorization. An example of that would be a journal entry. Every ledger I've ever worked with, and I've done accounting for 4 different businesses, is before a journal entry would go live and post, it had to be approved by somebody. So basically one person would create a journal entry and another person would have to approve it. So basically when I was the CFO of a company, the way it would work is journal entries would have to be approved by somebody else. Okay, so basically somebody did some journal entries to update the accounts for one of the properties they were managing. They had to give the source documentation for those journal entries to somebody else, and then that person reviewed them and said, yes, that's correct. And there's basically an approval button in the ledger, so one person did the entries, another person did approvals just by clicking yes, we approve, I approve, I approve, and then the source documentation after it was reviewed would just be filed. So that's very common that one person does something, somebody else reviews it before it's will affect the accounts. Physical control of our assets and records. So internal controls is more than just accounting policies. It also deals with the safeguarding and keeping of assets and making sure that nobody who is unauthorized has access to assets. So just think about a company's money in a bank account, right? Typically when you open up a bank account, there'll be a signature card, and that signature card has all the information for the people who are authorized to access the account, sign checks, do transfers, and so on. And anybody else should not have the ability to access the account. It could also mean logging into a computer. Maybe there's a policy at your job that means if you're away from your desk, you have to be logged out of your computer. Because if you were not logged out, that means somebody could sit down and send out emails or access the accounting system or something like that and start to do journal entries without your knowledge. It could mean if you have a company vehicle or company vehicles, that only authorized people who have insured, gone through training or safety, whatever it is, should have access to the keys to be driving a company vehicle. So it's all kinds of things like that too. It's not just an accounting system, it's what controls do we have in place to make sure that all company assets, no matter what they are protected. We've got physical control over them, and the same thing with records, that records are organized, they're stored safely. It could be, I worked at a place where every night file cabinets had to be locked. Okay, and every morning a couple people had the keys to unlock them. Okay, so it could be something as simple as that. Basically, during non-office hours, those were locked, so that somebody else couldn't come into the building and just start taking files. Detective controls, basically, do we have adequate documentation? Do we have good records? Are we doing well on our record keeping? Organizing our material, making it easy for somebody to come in and look at our source documentation, find it, and prove that journal entries were done correctly. And then independent checks on performance, of course, would be an audit, and having somebody else come in and verify the accuracy of the numbers in your financial statements. So just some things about segregations of duties, more specific than what I mentioned earlier. Obviously, somebody should have the ability to authorize or approve the execution of a transaction. When I was the CFO of a company, I was the main check signer, and 2 people had to sign a check. I had 5 people who were doing accounting for different properties. They would pay the bills, write the checks, and so on to handle those. Well, they came to me. And so they would give me a packet of checks, and each check would have its source documentation behind it to basically a vendor invoice or whatever it was. And I'd go through, approve all those, verifying or paying the right vendor, the right dollar amount within a timely amount, and from the right checking account also, and sign it. And basically I would sign it, and there was about 6 of us in the office who were check signers, so I'd give it to somebody else who would do the same thing that I did. So that authorization process, right? Somebody else executed that check, but other people are verifying the accuracy of that check. Record keeping, recording the transaction in the accounts, obviously, right? So once basically once those checks were signed, they were then given back to the accountant, who then did the journal entries for the checks and then sent off the invoices with the checks to the vendors to pay them, and then filed any other source documents in our file cabinets. And then custody of assets, just that physical possession or control of assets involved, whatever those are. If it is cash, if it's inventory, if it's a company vehicle, computers, whatever it is. If your company has laptop computers where you work, there's probably a procedure about where to store a laptop, where to keep passwords. So a lot of companies out there have had customer data stolen or sensitive records stolen from laptops being left in somebody's vehicle, and somebody comes along and sees that there and breaks into the vehicle, steals a laptop. So you might have company policies regarding things like that too. Okay, then we kind of have to talk about what they call earnings management. And earnings management is, just like it sounds, management doing things intentionally in order to make our financial statements look better than they really are. So sometimes what happens is, company projects it's going to have a really good year, things start out great, and then maybe the economy takes a downturn, or all of a sudden you've got competition that you didn't think you would have, and for whatever reason your numbers start to go downhill. Okay, and management doesn't like that. So instead of looking for an operations solution, in other words, do we need to expand our product lines, advertise more, cut our prices, whatever the true operations should be happening, instead management thinks, well, let's just see if we can't stretch the truth, quote unquote, in our accounting records to make our numbers look better. So that's obviously, earnings management is not a good thing. There's different levels of earnings management that we'll talk about here in a bit. But it happens for a lot of reasons. Meet internal targets, right? Quite often companies have goals. You should have a goal, right? You should have a plan that says, our goal this year is to achieve earnings of X, or revenue of X, or return on equity of a certain number. Every company should have goals. You should strive to meet them. However, that the accounting solution should not be used to achieve those goals. It should be more operational. To meet external expectations, publicly traded companies have analysts who look at them and make earnings estimates. So you've got these investment banks out there, and they have people who analyze a sector of the economy, and they'll focus in on certain businesses within that sector, and they'll publish what they call earnings estimates. And they'll basically say, we expect this company to have earnings per share of $1. And if that company comes up short, that would, as crazy as that will be, if they came up at 98 cents of earnings per share, that might actually result in your stock price going down. Even though you're only 2 cents off, the expectation was $1. You didn't meet that, therefore your stock price goes down. And it's kind of a strange phenomenon, but that's how it works with publicly traded companies. And so there's pressure on the companies to meet those expectations. Next is income smoothing, carefully timing how revenues and expenses are recognized to even out earnings from the year. And GE is one that's been that does that for better or for worse. And GE is so big, they have so many different divisions, they're in so many different things. They're in insurance, they're in finance, they're in banking, and then they're also in what we normally associate them with is, obviously consumer electronics, light bulbs, medical equipment, jet engines, train engines. They make all kinds of things, but because they have so many different divisions, if one division is going to have a bad year with some write-offs, they could carefully recognize some gains in revenues in another division to even that out. And so not all companies can do that, but a bigger company might be able to figure out how to do that. Then the last one's called window dressing for an initial public offering or a loan. And so if a company is privately held but is thinking of going public, Its financial statements right before it goes public are a really big deal. Investors will rely on those as a part of stock price when the stock is available for sale, or even to get a loan. If you company needs a bank loan to expand or grow its operations, obviously you want to give that bank the best possible financial statements you can. And so those are just all reasons why earnings management happens, for better or for worse. And typically this is not a good thing, just so you know. So on the spectrum of earnings management, you've got on the left-hand side, you've got items that are within GAAP, to the right-hand side where basically we're way beyond GAAP and we're doing stuff that's highly illegal. And if we're caught, there's going to be some jail time and fines and things like that. So on the left-hand side, it says savvy transaction timing and strategic matching. And so what that means is, with accounting, there's a lot of estimates in accounting, and we really haven't gotten to those yet. But we're going to discover that when it comes to depreciation, there's several methods you can choose. When you kind of book bad debt expense or warranty expense, there's lots of things that we have to estimate, because accountants basically say we have to stop and measure. And we do that, typically once a month, but at a minimum once per year, we have to stop and measure. But we have to guess things are going to happen in the future. And so there has to be estimates in accounting. It's not, we can't say for certain things are going to turn out the way that they will, but we can estimate that they will. And so with that savvy timing and strategic matching, we're trying to match expenses to revenues, and we can kind of stretch the truth a little bit when it comes to some of our estimates. And so that's what they mean by that. And the second one, aggressive accounting and changes in methods or estimates with full disclosure. There's like 4 different ways to account for depreciation. There's about 4 different ways to account for inventories. There's different ways to account for investments. There's different ways to account for bad debts, and there's all kinds of things. We have several GAAP methods to choose from, and depending on the GAAP method we choose, it will impact the bottom line. And so with that in mind, what they're saying with this is we are aggressive with the methods that we use, and we change the methods, and we do give full disclosure. And so the financial statements that a company will issue are typically, there's about a page for each of the main financials. For the income statement, statement of equity, balance sheet, cash flow, each of those is about a page. But then you could have hundreds of pages of notes after that describes all the information, all the background, and gives a lot more detail about the numbers in the financial statements. And so we're saying that we're being aggressive, but we're disclosing it. We're kind of putting it in the fine print in the notes, which not everybody looks at. Okay, and businesses obviously know that. Then you have deceptive accounting in the middle. So now we're getting to the point where, okay, now we're stretching the truth with GAAP, and we're getting to the point where there's a potential for fraud, or we're intentionally doing this, and now there could be some trouble. And we make changes in estimates or changes in accounting principles without disclosure, right? So we change from one GAAP method to another and don't disclose it, which will be very deceptive and misleading, because that changes numbers and it makes comparability between years very difficult. So we're intentionally being deceptive, right? We're changing something and not disclosing it. Now we get to fraudulent reporting, where we're just doing non-GAAP accounting, where we know the GAAP rules, but we're throwing them out the door and just choosing some other method that makes our numbers look really good. And then we get all the way to fraud, where we're just making stuff up, right? We're just booking revenues and making our numbers look really good without anything to back it up. We're intentionally doing things wrong. So basically the first 2 are within GAAP, we're kind of on the edge of GAAP, but the other 3 are deceptive. We're intentionally misleading somebody to make our numbers look better than they really are. And so here is the GAAP oval. And the book obviously talks about that in more detail, and you should always read your chapters to supplement what I've been telling you. But obviously, we've got that GAAP oval, and within that oval, we're within GAAP, but then we can be outside of that, where we're kind of stretching the truth. Okay, so how do we prevent those things from happening? Those earnings management issues that we have. Obviously, auditors are on the forefront of preventing those types of things, but not every company has to be audited. Publicly traded companies have to be audited, and they have to have internal controls, and both the controls and the financial statements have to be audited by external audit firms that are independent. And you could probably recall, many of you, maybe not everybody, but back in the late 90s, early 2000s, we had some big companies out there that were publicly traded that intentionally falsified financial information and did some really bad things. And the Sarbanes-Oxley Act was a result of that. It was passed by Congress in the summer of 2002. It went through pretty quick. And Paul Sarbanes was a senator, and Michael Oxley was a member of Congress. And it's their names that are on the bill. And President Bush signed it in the summer of 2002. And the purpose of it is to oversee public accounting firms. And the reason this bill was created was really just due to some serious lapse of judgment of people in the accounting world who both were working for industry and for audit firms. And so I'm guessing most of you have heard of Enron. Enron was an energy company based down in Houston. And we also had another company called WorldCom, which was a telecommunications provider. It was US West once upon a time, and now somebody else bought it, and I forget who bought it. But so it still exists in a form, but the company itself, kind of went out of business, and somebody else bought the remnants of it. But anyway, same thing with Enron. They went out of business, and other companies kind of snapped up what was left of the assets and just continued the operations. But what happened is that Arthur Andersen was at one point in time a very large national audit firm. And Arthur Andersen was the audit firm for Enron. And the Houston office of Arthur Andersen did the audits for Enron. Well, in addition to the audits, they also did consulting. In fact, they had designed and set up and implemented Enron's accounting systems, and a lot of their information systems Arthur Andersen actually created and ran and so on. But they did a lot of consulting, so much in fact is that the consulting revenue was in the tens of millions, while the audit revenue was hardly anything. It was under $1 million. And so the problem with that is that Arthur Andersen was not actually independent. They were too afraid to go to Enron and say, we know that the accounting you're doing is bogus. We know you're just making stuff up. We know you're hiding assets. We know you're doing a lot of bad things. They knew it and never told Enron, stop it. They just kept on issuing clean audit reports and saying the numbers are accurate, when in fact there was a lot of problems with the Enron financial statements. And so to kind of keep that from happening again, Arthur Andersen no longer exists because of this, by the way. The Sarbanes-Oxley Act created what they call the PCAB. It's PCAOB, and people in industry call it the PCAB. And it's a board that oversees accounting firms. So any accounting firm that wants to audit a publicly traded company has to go through basically approval by the PCAB. And so the PCAB has the ability then to tell a firm that yes or no, you're not going to be approved to audit publicly traded firms. And obviously that's very powerful. They can issue rules regarding audits, and any firm that then goes through the PCAB certification process will be audited by the PCAB, and they're going to make sure that audit firms are indeed doing their jobs correctly. So they're going to audit the auditors, kind of an independent board that's holding accounting firms accountable. The second one is a constraint on auditors, basically saying that audit firms can no longer provide certain services to clients. Okay, so you cannot audit a firm and do consulting. You have to choose one or the other. And then the constraints on management, there's been a much more stronger emphasis under Sarbanes-Oxley of the importance of internal controls. So management has to do an audit of internal controls, and so does the external auditor. And having worked for a publicly traded company, internal audit did the audit once a year, about 6 months apart. Internal audit would do basically a internal control audit, and then the outside auditors once a year would do an internal control audit. So you had it being audited twice a year, once by internal auditors and one by external auditors. So the role of auditors, there's both internal and external auditors. Internal means you're working for the company. So it means you're not independent, but that's okay. In big companies I've worked for, internal auditors have had a lot of power. Basically, what happens is that who's ever head of internal audit does not report to the CFO of the company. Instead, they typically report to the audit committee of the board of directors. So they're going to basically have 4 or 5 members of the board of directors will have a subcommittee called the internal audit committee, and that's generally who oversees the internal audit function. So it's completely separate from a company's actual CFO and all the people that would report to the CFO. So they've got some power because of that. At least they're supposed to. And their job is to make sure that the integrity is in place for financial records, and they really do that by making sure that controls are working. And so one of their main jobs is to continuously and always be evaluating and doing training and encouragement to follow internal controls. So a part of their process is designing controls and verifying that they're working, doing reports on those controls. So let's just say a company, where I was at, where I was really involved in internal controls, was an insurance company. And obviously with insurance there's a lot of money going on, a lot of payments going in and out, and so you're just trying to make sure that you were verifying the accuracy of accounting and verifying that controls are working correctly. And so they would design controls, and quite often that would happen as systems changed, as there was a reorganization. Maybe that happened quite a bit with businesses. You do a reorganization, well, as that changes, controls have to kind of follow along. Same thing as systems change. I know one of the last things that I was working on when I was there was helping out with a claims system. They were completely redoing the claims system, which meant that controls had to follow along with this new system. So internal audit was very involved in that. So just evaluating controls, making sure that they work, doing training, and then doing the actual internal control audit once a year. And you have external auditors who are completely independent. They work for another accounting firm. They come into the business and they're verifying the accuracy of financial statements. Plus, of course, they're also verifying that internal controls are in place, they're being followed, and that they can be relied on. So auditors then, processes that they do, you can see interviewing, observation, sampling, confirmation, and analytical procedures. So interviewing is talking to people who are doing the accounting work at all different levels of the organization, from bottom to the top, and all levels in between. Just sitting with somebody, watching them do their job, asking questions, verifying that they're following the policies in place. Looking at output, looking at checks, have they been signed twice, looking at invoices, have they been properly verified. By doing sampling, it's basically, let's just say we want to sample receivables and verify that they exist. You send out confirmation statements to people who owe the business money, and you're verifying that the amount that we show as what is owed is that that truly does exist. What you want to try to find is, did somebody make up a fake company to send to bill and receive money back from? You're looking for things that just don't make sense. And analytical procedures is basically you're doing sampling of transactions. It's very much getting involved in the systems of the company and verifying that they work. And you have GAAP. We talk a lot about GAAP in this class. We also have GAS, which is Generally Accepted Auditing Standards, which are the policies and procedures that auditors have to follow as they do their job. And last, we'll talk about the SEC. The SEC's role in accounting is a pretty big deal, and it's really, they oversee anybody who's publicly traded. And so if you work for a publicly traded company, you might be involved with the SEC, and basically they make sure that investors and anybody who invests their money in a security, so if that's a stock or a bond, that you have all the information you need about the company as you make that decision to buy that stock or bond. And so they have the ability to establish accounting standards, so they can create GAAP rules However, they don't do that very often. They typically let the accounting profession do the rules. But of course, if they say, hey, here's something that we're looking at, this is a direction we want you to go, typically, the FASB will listen to that because they know if they don't, that the SEC can just create the rules. If they suspect that there's insider trading or some irregularities, they can force a security to come off the market, which is basically a really bad thing for a company to have happen, right? If nobody can buy and sell your stock, and they require all kinds of disclosures. So once a quarter, you file a 10K. Then annually you file a 10. Once a quarter you do the 10Q. Then annually you do a 10K regarding filing with the SEC, giving them financial statements, disclosures, audited financial statements once a year, and they call those registration statements. Basically, when you first go public, that registration process, if you issue additional shares of stock, all those things that are involved with filing with the SEC, very important. Okay, so the SEC has a lot of power over companies when it comes to regulating the financial markets. So they play a very big role in our financial system. So that's Chapter 5, much more qualitative than quantitative. It's more about how things work than it is number crunching. So it might be a nice change of pace for you after the first 4 chapters of the class.